So today we're going to be talking about whole life insurance, the pros and cons of it. Now, full transparency, I just spent about a half hour scouring the internet looking for the cons of whole life insurance. Obviously, we talk a lot about the pros, and so I thought to myself like, hey, let's do a pros and cons video on whole life insurance, talk about the positives and the negatives. And so for myself, I just said, you know what, let me go and check and look for people who are talking about the pros and the cons, see what they're saying. And what I came up with was a lot of people who are anti-whole life talking about the negatives of whole life insurance. And you know, what I realized was there's a wild misunderstanding about what whole life insurance is and how it works. And so what I'm gonna do in this video is I'm gonna talk about the pros and cons, but I'm gonna do it through the lens of going through how other people are talking about it to set the record straight. So if you haven't already, make sure you subscribe and hit the bell, that way you're notified every time I launch a new video. Let's go. Hey, what's going on, cash flow hackers? It's Chris with Life 180, and for this video, we're talking about the pros and cons of whole life insurance. I'm going to be going through some of my own thoughts on it. I'm also going to be going through some of the content that I found online about it and talking about how other people are kind of misrepresenting what whole life insurance is. And I figured the best place to start with this is my good old friend Dave Ramsey, tongue-in-cheek, haha. So what I thought would be interesting is to spend a little minute and go through something that I found here. Now, this is a thing on his site, Ramsey Solutions, where you can see he talks about it. So he says whole life cons and pros. The pros, the only one we've discovered, whole life is better than no life insurance at all. Hunting for good things about whole life could become a new hobby. Trying to think of whole life benefits could help you build patience. Still waiting, right? So they're being like super condescending. They're trying to position it like whole life has nothing positive to provide the world at all, which I think is really funny because banks, large corporations, the wealthiest people in the world, they're all the people that utilize whole life insurance. So Dave Ramsey has a habit of talking to broke people who are trying to get out of debt, who have a broken and scarcity mindset for the most part. And what happens is he helps them get out of debt, but then when it comes to creating wealth, he hurts people and tells people that they can have assumed rates of return that are crazy. He gives these crazy examples as I go down here of assuming 11% average annual rates of return on your investments, which honestly, if he were licensed and told you could expect that, he'd probably get sued and get his license taken away from him. And it's complete financial malpractice, in my opinion, to tell people that they can expect an 11% return over the long run. Now, year in, year out, who knows, obviously, but on a predictable basis, that is just not a realistic thing. So there's a thing he says, let's go through his cons really quickly, and that'll help me work into some of my own. So con number one, whole life insurance is more expensive than term life. Now, from a cash flow perspective, whole life insurance is more expensive, right? Whole life insurance is more expensive than term life. But the bottom line is if you look at it and you structure it properly, then while the cash flow can be higher or will be higher than a term policy, that cash flow is performing multiple duties. It will be a savings alternative for an emergency fund, which Dave Ramsey is a huge proponent of, and it will also be your term life insurance, right? And it's a forced plan to help you get there. Now, one of the downsides to this, so I'll talk about the cons of this, because I do believe that utilizing a whole life insurance policy as a savings alternative, not an investment alternative, because that's where he gets it wrong. Dave Ramsey is always talking about the fact that whole life insurance is not a great investment. Well, no, it's not, Dave. I've done videos on this. It is a savings alternative. You can't compare whole life insurance to an investment because the profile of the asset is completely different, right? Investments, you can lose money in. There is an inherent amount of risk. With whole life insurance, it's guaranteed. It's the only financial product in the world pretty much that you can actually stamp a guarantee on the growth of it if you just contribute. Now, what I will say is, to his defense, one of the cons of whole life insurance is that people are designing them horribly. If you just do base coverage to base coverage for term policy, basic premium, and then base coverage for whole life insurance, well then it's going to be horrible because your cash value in the whole life policy is going to be completely illiquid, right? You're going to have no cash value for several years, and it's going to take you probably 15 years to break even on the cash value. Now, obviously, from an emergency fund perspective, that's not going to work, right? But one of the things that we talk about all the time is that we can do this, that you can build your money in a safe place, right? You can have safe, liquid, accessible, guaranteed capital for emergency, for opportunity, for whatever you need. And you implement what we call a forced savings plan, right? It's going to give you a guaranteed death benefit. I want to speak to this really for 1 second, because I'm going to tell you, I don't know, 10 people over the last month that had term policies that basically followed Dave Ramsey's advice. They didn't say they followed his advice, but they basically followed his principles, right? Where they were like, I'm going to buy term, I'm going to invest a difference. The goal is to become self-insured, or whatever, and I'm going to get into that after. But the goal was to become self-insured. So we bought 15-year term because the kids were 5 years old, and so by the time they're 20, the goal is to be not needing the insurance the same because the kids are out of the house. And at the end of the day, these people were 45 and 47 years old, and their kids were now gone, or they were going to college at the time. But the bottom line is this: the guy who is the primary bread earner in the family, the kids are gone, but he's still only 47 years old, right? He still has all these years to work. Still had another 18 years in his career, and now he's diagnosed with cancer. And his term policy, because he got the cheapest of the cheap term with Dave Ramsey's advice, which is exactly what Dave Ramsey would advise, I should say. He did that, and now he's not able to get more insurance. And he wants it more now than ever, and he can't get it. And he still has an insurable need, because while his kids are gone, he doesn't have enough money. If he dies tomorrow, his wife, who's been a stay-at-home mom her whole life, or while the kids were there, his wife is going to have to take a massive step back in her standard of living. And not to mention that the term insurance that he has, because it was the cheapest of the cheap, doesn't have living benefits associated with it. With whole life insurance, he would have had living benefits where he could access the death benefit while he was alive to help pay for his medical treatments. That way it wasn't as much of a burden on the family, right? And so these are just things to think about, that life insurance it shouldn't just be death insurance. It's how do we utilize it in life? In fact, now you can use life insurance to stay alive if you do it the right way, right? So the thing is Dave Ramsey's always comparing, well, why put your money in a whole life policy? Because it does, if you try to use a whole life insurance policy to be insurance and an investment, it does neither well. That's what Dave Ramsey says. That's his quote, right? But the bottom line is, you don't utilize it to be life insurance and an investment. You utilize it to be life insurance and a savings alternative, right? And it's safe money. It's going to beat inflation. It's going to beat your savings account. That's important to understand. It is not an investment. You are not looking at whole life insurance as an investment. And I would argue, if you are looking at it as an investment, you're doing it the wrong way. Another pro of whole life insurance is you get a guaranteed death benefit. The con between having a guaranteed death benefit and a whole life policy is that oftentimes when you design it properly for growth and to accomplish your financial goals and objectives, you're not going to have enough insurance. You're just not going to. So you need to fit it into your plan, and we need to stop thinking about products solving our problems and think about what's our plan, reverse engineer a plan to get there. Oftentimes, unfortunately, we need to get supplemental coverage. We would need to get a term policy with the ability to cover our insurance gap, our need for insurance for people. Now, that said, if I'm going to get a term policy, let me talk about this for a second. If I'm going to get a term policy, I'm going to get a convertible term policy. Most stock companies are not going to offer convertible term policies, or if they offer convertible term policies with a stock company, they're only typically going to be convertible to crap products like universal life, index universal life, things like that. You need to get a convertible term policy with a participating mutually held company, and that policy can be converted to a properly designed whole life insurance contract. And that is, if you are going to need to supplement right here, you need to make sure that you supplement with a convertible term policy, not just the cheapest of the cheap term, because otherwise you wind up in a position where you got a 15-year term, 13 years into it, 10 years into it, you get cancer and you live beyond the term, and now your family is toast, right? They're not ready. And by having a convertible term, if it happens to you in that situation, you're going to be able to convert that coverage to permanent insurance and make sure your family is actually taken care of. Like I said, it's a forced savings plan. Now, here's the thing. When you look at life insurance as a forced savings plan, I've done this before. So I think this is one of the things that I think is really important to understand. When we look at it as a forced savings plan, one of the mistakes that people make is they design these policies to be too inflexible. They're not flexible enough. And so what I want to do really quickly is I want to show an example of a policy to show you how it can be leveraged as a forced savings plan, and how in that forced savings plan with a whole life policy, you actually have more flexibility than you realize. Let's check this out. So here's what I'm going to do. I am going to go there, and let's talk about this really quickly. So imagine you're saving $1,000 a month, and the goal of this $1,000 a month is to get to the place where you have your emergency fund saved for retirement. Now, I'm taking a 30-year-old in this situation, 30-year-old, and what we're doing is we are going $1,000 a month. Check that out. And you can see year one, now what Dave would say is, why would you pay $1,000 a month, $12,000 a year for $281,000 of death benefit? Well, we were doing that because we're not really paying $12,000 a year for $281,000 a year of death benefit. He would say that that's infinitely more expensive, which if you do compare it apples to apples from a cash flow perspective, he's absolutely right. The difference is you actually have $10,664 of cash value. So if you back that off to $12,000, you're looking at like $1,300 of expense. Now, is that more expensive than the traditional term? Yes, it is, but you are also getting permanent insurance that goes with it. Now, what Dave is going to say is that, well, this is still a ripoff because the death benefit, you don't get to keep the death benefit and the cash value. The life insurance company is going to keep the cash value, not the death benefit. Well, what Dave kind of positions here as a negative to the whole life policy is actually a positive. You could see here as the death benefit goes up, right? You start at 281, we got 1064 there. Year two, we put in 12,000. The policy grows by 11,553. So the net cost of insurance that year goes down, right? Because we still have this insurance and the insurance gets cheaper on a net basis, right? Because I'm paying 12,000, I'm still getting the insurance, but look at this. My death benefit went up. I paid another $12,000. My cash value, my policy value grew by 11,553, but the death benefit grew by even more. It grew from 281 to 310. You could see the next year we paid 12,000 in. Our policy is growing by $12,100. So on a dollar in, new money in basis, the policy is growing by more. So the net expense, comparing it to our savings accounts, is negative, right? We're actually coming out ahead. You can see now after 3 years, we paid $36,000 in premium, but we have $34,317 in cash value. Our death benefit continually goes up. And this is where I said you could see this is probably not enough life insurance to cover everything, but this is where you're going to need to supplement with a convertible term policy like I was just saying a couple minutes ago, right? Now, imagine you have a household and you have $100,000 a year of income or $120,000 a year of income. The goal is to get to $60,000 or 6 months of income as an emergency fund, right? So you can see here in year 5, we've put in $60,000 and we have $60,000. So it's the same as a bank account would have, but you have all these other benefits. So the problem is when we talk about the cons, the cons get talked about like this is some ripoff, it's more expensive. It can be if you do it improperly, but if you do it the right way, it's absolutely amazing. You can see here, I'm just going to jump ahead. By year 10, we put in $120,000, 12,000 times 10. We put in $120,000 total premium. We have $136,000 of cash value, which is ahead of where our bank account would be. We have $550,000 of death benefit, which is because we had to use a term rider to allow us to fund this properly. And then at year 10, we completely pay up this policy. We have no more expenses, no more charges. It's a completely paid up policy. And now we have a bank account with no more expenses, no more anything, with the death benefit dropping back to $312,000 because of the fact that we did have it pay up, and we did remove the term policy that allowed us to do this. But imagine the alternative. During this 10 years, we could just put the money in a bank account, and we're going to be behind from even just a cash value perspective compared to this policy, right? And he says, well, the life insurance is going to keep the term, or is going to keep the death benefit, or is going to keep the cash value and only pay the death benefit. Well, if you saved only in a bank account, you'd only be passing on this 142. You wouldn't even have the extra. The reason that they do what they do is and keep the cash value and add it to the death benefit is because of the fact that the death benefit gets passed on tax-free, whereas the savings account would be taxable. Now, as you can see, this is going to continually grow. So is the death benefit. It's going to grow. So is the death benefit. And you can see this death benefit is going to constantly grow every single year into perpetuity, and that is the way it works. And so when you look at this, it really becomes kind of a no-brainer when you look at how whole life insurance is massively mischaracterized by all these people that don't like it. Now, the area that I agree with them, it's not an investment. Whole life insurance should not be considered investment because it's not going to give you the upside potential of an investment. But if you want to be a good investor, you need to build your foundation of safety. You need to have your safe, liquid, accessible capital, your emergency fund, an opportunity fund. You need to be good to go with all that stuff. And that is the important part. Now, the part that I didn't talk about that I meant to talk about that I got a little distracted by is the inflexibility con of the forced savings plan. Now, what I want to show in this is I'm going to go all the way down to page 13 on this. Let me just go here, 13. And I want to do this. I want to go down. No, that's not the right page. Right there, page 12. So you can see here that your annual premium on this, that we're paying the $12,000. The minimum that you could pay is $1,558, okay? So I wanna make that really, really clear, okay? You can pay as little as $1,500 on this and as much as $12,000, I mean. So what does that mean? That provides a ton of flexibility in between. If you can't come up with $1,000 a month, you're not screwed. You're not just like up the creek without a paddle. You don't just lose the policy. You don't just lose the opportunity. It doesn't just lapse on you. You don't have all these problems in a way that all these people that are anti-whole life would have you think. You have that big window of premium that you can fund it by. Plus, if the policy is older, there are all sorts of things that you can do to circumvent that issue as well. I'm not going to get into that here because it gets really complicated. But on a simplistic terms, I just showed you the minimum premium is $1,500-ish and the maximum is $12,000, right? And so that's pretty straightforward, and that's contractual, right? On a whole life policy, when you sign on the dotted line, all the contractual rights are in your hands, a policyholder, and not the life insurance company. I just showed you one of the pros is it's very, very liquid. When you put money into the policy, it's extremely liquid. But the con is it needs to be specifically engineered to meet your goals, right? Now, the other pro is that it comes with a ton of tax advantages. The money's going to grow tax-free. You're going to have tax-free access while you're alive. It's going to provide a tax-free death benefit. All really good things. But the benefits of this, or the cons are, it depends on your beliefs, right? I'm a big believer you need to align your money with your values and your beliefs. One of the challenges is I believe taxes are going up. If you believe that taxes are going up, if you believe that our government is having all sorts of issues with our national debt, with inflation, with the interest rates, with unfunded liabilities, if you think any of that is a challenge, well, then there's a lot of problems. You want to put your money into a place that has tax advantages that are going to benefit you and protect you from any of those consequences, right? Any of the negative consequences and unforeseen consequences that are going to come from the environment that we're living in and what we're going through. We are in unprecedented times. We're $31 trillion in debt. We have 170 something trillion dollars of unfunded liabilities. Inflation is going out of control. I think it's going to get worse. I think it's come back, but I think it's going to get worse again. And listen, we have a lot of issues. I think the political uncertainty, the stability of the dollar, all this are real viable concerns. I think it's it's inevitable that the US dollar is going to have challenges at some point in time. Unfortunately, I think a lot of people are taking that inevitability and bringing it to the context that they're saying it's imminent, meaning it's going to happen sooner than it really is. And the banking system right now, as I'm making this video, is going through all sorts of turmoil. Banks are failing, the SVB, like stuff of that nature, like other banks have had issues. There's been reports saying that there's 180 banks at risk of failing right now. That's a really, really tumultuous set of information that people just are getting uneasy about, right? And they don't know how that's going to impact them. But the bottom line is what you can do to control it is by putting your money in a place where it's protected against all that, that doesn't implement the traditional fractional reserve banking system tactics and methodologies. And my belief here is if whole life were so bad, then banks and corporations, the biggest corporations, wouldn't be the biggest holders of them. Wealthy people wouldn't be the biggest holders of these types of policies. It's not something that the more money you make, like the idea of being self-insured is a broke person's mindset. Quite frankly, it just is a broke person's mindset, because if you want to get self-insured and you want to have enough money, well, that tells me that you got to a certain place and then you're just happy to just stop and you're willing to be stagnant. And if I'm a believer that life is about growth, life is about the journey, life is about expansion. And as soon as you stop growing, you start dying. That's just my belief. And so from that perspective, as soon as you get to a place of self-insured, you want to keep creating. If you keep creating, you're going to create all sorts of other challenges that are going to leave tax liabilities. They're going to make it so your estate doesn't transfer to the next generation in an efficient way. You're going to have to pay the government many more tax. A much higher percentage of your estate is going to go to the government in the form of taxes than to your heirs, right? And I don't know about you, but for me, when I get to that place and I have to be going, passing on to the next life, and my next generation is going to be inheriting my estate, I want to make sure I leave as much to them as possible and as little to the government. Wealthy people know this. That's why they do this. That's why they utilize permanent cash value whole life insurance and not term life insurance, because term is not going to be there when you need it most, right? The idea of being self-insured is a broken mindset, in my opinion. So anyway, that's kind of like the pros and cons from my perspective. I get some of what they say, but it's full of half-truths. If you design policies improperly, you can run into challenges. This is the importance of working with somebody who truly understands how this stuff works, how policies, when they're designed properly, can help you, where they can fit into your life, what problems they can solve. Once again, it's like Stephen Covey always said in the 7 Habits of Highly Effective People. We got to begin with the end in mind and reverse engineer a plan to get there. We got to set expectations in alignment with reality, make sure that we implement the plan and execute that plan, right? Like we gotta design a plan and execute a plan to get to where we want to go. And what I know to be true is a properly designed whole life insurance policy is literally the only financial tool in the world that will make sure what you want to happen will happen when you want it to happen, whether you're here to see it or not. Are there cons? Yes, there are cons, but most of the cons exist in improper designing of the policies. And what I will say to the defense of Dave Ramsey, Susie Orman, and all the other influencers that love to hate on whole life insurance, what I will say to their defense is that unfortunately, 95% of whole life insurance agents have no clue how to design a policy properly to be engineered in a way that's going to benefit you in this way. But I just showed you one example, and if you looked at that example, I don't know how you would look at that and be like, oh, compare that to a bank account, not an investment, but a bank account, which you need to have money in a bank account. I don't know how you look at those two and don't go, whoa, this is a no-brainer. Like, if you look at that and don't think it's a no-brainer, I would question you to go back, pause it on that screenshot, and really think about it and ask yourself some questions, because it's a big deal and it can have a massive ramifications on the potential future of your financial life. So that's it. If you have any questions, go ahead and comment in the comment section below. If you haven't already, make sure you subscribe, hit the bell, that way you're notified every time I launch a new video. I got things like this coming out every single day. That's it for now. Have a blessed, inspirational day. We'll talk soon. See ya.